Having already accumulated $100,000 for retirement means you're making significant progress towards achieving $1 million in savings. Transforming $100,000 into $1 million might appear challenging initially. However, the reality is that accumulating the first $100,000 poses the greatest hurdle. Once you reach six figures in retirement savings, compounding begins to accelerate rapidly. Your task is to sustain this momentum and contribute further whenever possible. Outlined are 4 methods to increase your retirement savings from $100,000 to $1 million. Welcome to Money and Investment, where your financial future starts today. Ever wondered why starting to invest when you're young is a game changer? Let's dive in. Investing in the stock market might seem daunting, but it's a powerful tool for building wealth. Why? It's all about time and compound interest. Starting young means more time for your investments to grow. Think of it like planting a tree. The earlier you plant, the longer it grows and the bigger it gets. Worried about risks? The earlier you start, the more time you have to recover and learn from market ups and downs. And if you're starting at 50, no worries. It's about choosing the right strategies suited to your stage in life. Number 1. S&P 500 Index Fund. Investing in an S&P 500 index fund may not promise extraordinary returns, but it ensures you stay on par with the market average, a feat challenging to achieve. Over 90% of actively managed mutual funds fail to outperform the S&P 500 over the long haul, making an S&P 500 index fund a favored choice, including by Warren Buffett. Historically, the S&P 500 yields an average compound total return of 10.2% annually through price appreciation and dividend reinvestment. Placing $100,000 in an S&P 500 index fund could potentially yield over $1 million within 24 years if historical returns persist. Accelerating this process is possible by continuing to save. Investing an additional $500 or $1,000 per month alongside the initial $100 could lead to reaching $1 million within 20 or 17 years respectively. Top S&P 500 index funds include the Vanguard S&P 500 ETF, VO, and the SPDR S&P 500 ETF Trust, SPY. Number 2. Growth stocks. Growth stocks offer the potential for superior portfolio returns. These stocks exhibit above-average revenue growth and are anticipated to deliver robust earnings growth in the future. While growth stocks often trade at high valuations relative to their current financial performance, they can be subject to increased price volatility as future expectations unfold. Despite this volatility, investors expect better-than-average returns from growth stocks. Diversifying a portfolio with growth stocks is essential to mitigate risks associated with individual companies. Investors can achieve diversification by purchasing individual growth stocks or investing in growth-focused exchange-traded funds, ETFs, like the Vanguard Growth ETF. Number 3. Dividend stocks. Companies that consistently generate excess cash often distribute dividends to shareholders. Select dividend stocks increase their payouts annually, offering the potential for market-beating returns, especially when dividends are reinvested. Over the past 50 years leading up to 2023, dividend growth stocks have outperformed non-dividend payers while exhibiting lower volatility. Dividend growth stocks also provide the option to use dividends for retirement living expenses once a savings accumulation is complete. Investors can access dividend stocks through individual selections or dividend-focused ETFs, like the Vanguard Dividend Appreciation ETF. Number 4. Small-cap value stocks. Historically, small-cap value stocks have outperformed the S&P 500 and large-cap stocks. These stocks belong to smaller companies trading at below-average valuations based on earnings. Small-cap value stocks have historically returned 14.1% annually as a group, though investing in smaller companies entails risks, particularly susceptibility to macroeconomic factors like interest rates. While small-cap value stocks have lagged the market in recent years, they have historically delivered better returns over longer periods. Index funds, such as the Vanguard Small Cap Value ETR or the SPDR S&P 600 Small Cap Value ETF, SLYV, offer exposure to small-cap value stocks, with the latter investing exclusively in profitable small-cap stocks included in the S&P 600 index, thus reducing overall risk. Concentrating on any of these strategies can facilitate the journey from $100,000 to $1 million through consistent investments. Ready to start your investment journey? Explore our channel for more insights on making smart, informed investment choices. Remember, it's never too late or too early to start investing in your future. Join us at Money and Investment for more tips and tricks on building your wealth. Subscribe and turn on notifications so you don't miss out.